reading, whatever you'd like to do.
Anything else for you, Betty? Or? Betty, do you have any other questions? Or you okay? Great. Paul.
Thank you. Yeah, just one last thing on this. I mean, the policy doesn't describe it as a benchmark. It just describes it as a reference portfolio. I think that's really important that we never call it a benchmark. That'll help eliminate some of the confusion. My other question has to do with the asset allocation, and it's just because if you look at the asset allocation, there's no allocation to innovation and risk, and yet later today we're going to be talking about innovation and risk, and that policy is going to say up to 2.5% can be in innovation and risk, and the point is that they kind of overlap, is my understanding, right? I mean, that 2.5% that's in innovation and risk, some of it's in RMS, some of it's in global equity. I just think we should clarify that within this document so that there isn't confusion about that.
No, good catch. And our plan was to bring this back again. And it's not uncommon for us to bring it back several times in a year, but to bring it back once we got to July 1st, and at your July meeting, bring it back. And specifically, right now, innovation and risk is part of absolute return. And so our performance people, thankfully, are very exacting, and they want it part of absolute return right up till June 30. And then at that night, it separates out. And RMS becomes RMS, which is most of the innovation and risk assets. About 2/3 of them go to RMS. The remaining parts would go to an innovation portfolio. We'll come back to you with this policy at the July meeting to then add that as an asset class. It would have a zero allocation, and we haven't quite worked on the name. It basically, we have some legacy portfolios, the Member Home Loan Program, credit enhancement, that have a small amount of assets in them. And I hate to go with the idea that we need a miscellaneous asset class or an other asset class, but we kind of are at that point. We're old enough as a plan that we kind of have some leftover stuff. I've proposed, a closet asset class, but something where we can, maybe it's the garage. But we need some place to put all these things together and list them. Recognize, as Paul said, that the long-term allocation is not there. It is always tend to be temporary. The 2.5% that's in innovation, it is envisioned, and we're finding that quite a few of the things innovation looks at are actually belong in an asset class. And so we would say in that policy, they'll be out in the asset class. The actual true innovation stuff that falls between an asset class is going to be pretty small. So I don't think you're ever going to see more than 0.5%, 0.7% of the investment portfolio in that other bucket, which would be good to keep that as small as possible because it's really just kind of it's got to be a catch-all.
So, Chris, if we approve this policy today, you're saying it's going to come back in July, and we would.
Yes, and I know that may seem awful, but it has to do with you adopted a new asset mix in November, so we're kind of getting long in actually formalizing that, and that would be important. But this would give us clearly a policy, because right now your only policy was from last year. This would give us, okay, here's the policy for the current fiscal year we're in, and then once we hit 15, 16, 17, boom, we have our new policy. So it'll be a small revision, but pretty quick.
So with the edit that Paul suggested, is the committee comfortable on taking action today, Stephen?
Sorry.
That's okay.
I just have one other comment I want to make. I'm not sure it requires a change, but just to give you a sense of at least where Makita falls out on this. On the INV 55, which has the migration of the asset allocation over time, staff put this in the context of step 1, step 2, step 3, which implies that at some point in time in the future, staff's going to come to you with a recommendation to adopt step 1, step 2, step 3. I think that it's highly unlikely that staff's going to have any information that is going to meaningfully inform them about when the right time is to move across some of these asset classes. And in some of the asset classes, staff has no ability to change the allocation, like in private equity and real estate. It puts you in an awkward position as a board to be recommending, to be approving changes in the asset allocation based on short-term valuation or other factors that the staff might be looking at. So I think from I think it's easier to have a migration path that is tied to a specific date, and staff can always come back to you and modify that if they feel for some reason that the date is inappropriate. But at least as a baseline, a date-based STEP program might make more sense than a discretionary one.
So what's your recommendation, Stephen? What's your,
Date-based. So
so you're recommending that we ask for that? Is that?
yes.
Okay.
Yes.
I just need explicit, yes, Chris.
So you like disagreement between your staff and your consultants. You got it. I have a T-shirt that says "Been there, done that." And Stephen, our history, the reason we went this way is literally from 1999 and then 2003 when we adopted new asset allocations. And Alan will remember, this really is partly what led to us to put so much money to work in private equity and in real estate in 06, 04, 05, 06, because we were chasing a target. And that was a common phrase we would use, is the target allocation says we better get there. And the deadline is by July, we're supposed to be there. I really felt strongly it caused us to chase targets. And I see your point of when do we move time instead of being investors. We've used this strategy twice now before this, and it's actually worked really well. And the way we come to you to say when is it right to be on step one, it's when we get halfway there. And it's so we're going to keep, we know the long-term goal, and we're going to keep aiming toward that. We simply adjust the asset allocation, and it really has a lot to do, Stephen, with the policy benchmark. That's what is shifting, is the benchmark you use to measure the portfolio. And we'll come to you, we'll look at it twice a year, June and December, and we would recommend a shift in the policy benchmark, that target, if we were halfway to that next level. So literally, 9.5, once we cross 9.5, we'll say, okay, now let's go to 10%. We're going to keep investing and trying to time a little bit the market and make this move smartly. But just like we said in closed session, we have a plan that we think is prudent on how to rebalance global equity and how to invest in RMS. If the opportunity presents us to move quicker, we will do so. But if like with inflation sensitive, I want to emphasize TIPS, global linkers went to a negative yield. We felt, well, there's no point in investing in that and chasing that when it is not a problem and it is a bad investment. And so let's delay it. So for us, this is art, not science. That's why we recommend the STEP approach rather than a calendar-based approach.
Got it. Alan, I'm kind of curious what you think, given the two opinions.
The experience in 06 and 07 drives my advice to you, and that is to give the staff a limited amount of discretion. They know what you want them to do. They have a target, a long-term target. In my opinion, they'll get there. And I think it's a legitimate concern that was raised. But in my mind, what I've seen is if you put a date, people will put the money to work because that's how they'll be measured. And I don't want to give people the kind of motivation to do something that doesn't make sense to them.
Thanks. Joy.
Yeah, just a question about the kind of the logistics of this. So does that mean that within some of the different asset classes, we could hit step one a year from now, but in others it could be a year and a half or 2 years? How does that fit together? And I think it goes back to a question Paul raised earlier about sort of where does the money then sit and move while we're between steps?
Great question. INV 55 is our neat, perfect world map. You all are smiling. You know what I'm going to say. The world is not perfect. And so that's why I said what we have found in life is that we end up coming back and saying, step one, we're going to recommend you adopt step half or step 1.5 or a variation. And the one asset class I would say global equity, we're going to keep marching there. RMS, we're going to keep hitting there. The one asset class that's really caused us internal consternation is the inflation sensitive. If global linkers stay at a negative yield, we know we can't protect ourselves from inflation right before it happens, but we don't want to chase negative returns. So we want to be a steady state investor. So we could easily come to you and say, you know what, let's adopt step 2, but let's revise inflation still at a 1% in target because we're not there yet. So each step we come to you will have to be fine-tuned to the reality we're facing at the time, but we'll want to adopt an asset mix that, as Alan said, continues us toward our long-term goal. But think about maybe a boat in the ocean. You have to kind of recalibrate where you are every time. So we've plotted a perfect course to get to that harbor, but the wind may blow us a little bit out of range, and we'll just come back to you and refine-tune it every time. We're talking about generally 1% to 0.5% of the asset allocation, which, if you remember from the asset allocation study, is really hard to determine. It's a very fine cut.
Thanks, Justin. Paul?
Yeah, I mean, I hear what Stephen is saying, and I think I'm not sure I think we need to change this, but I think he raises a really important point because it would be nice to have our investment beliefs so we know whether we think we can time the market or not. Because the point is that we adopt the asset allocation because we think that that's an asset allocation over the long term that's going to work. We don't do an asset allocation study every year. We don't do an asset allocation study every year as the market changes. We do a long-term asset allocation study, and then if we don't implement that, then that must tell us that we think we know how to time the market or beat our asset allocation model. And I'm not sure I think that we can do that. On the other hand, Alan points out the experience that we have had, and I also think that but I am particularly concerned about things taking too long. I mean, I think infrastructure is an example where we've identified long before I was on this board that we wanted to invest in infrastructure, but it's been very slow, and still that inflation-sensitive category would grow to 4% from 1% over several years. So at what point do we say, well, actually we made a mistake here in putting an allocation here because we can't put anything to work there, and so I think that what I like about what Stephen is suggesting is I think there is some accountability for saying we made a decision about asset allocation, we're going to implement it. At some point, at what point do we say, rather than de facto changing our asset allocation, we have to actually revisit this, and maybe we just have to be open to that.
I think there's a mechanism that's in place, and that is there's a constant review of asset allocation, and I think on a biannual basis, you should be reviewing how things are being implemented. And if, in fact, the staff is either, for whatever reason, not moving in the direction that the policy that you have adopted is being implemented, at that point, it's up to the consultants and you to say, why aren't you doing it? And so I think there's existing mechanism to address that issue without having dates, which you're not delegating anything because it's going to come back to you on a regular basis.
Sorry,
I was going to say, maybe one partial solution which solves part of this is to have a date indicated when it's expected the long-term policy will be reached, whether it's 2 years out or 3 years out. Because the big risk of this isn't just the timing of when these steps are taken, but that the steps are never taken because the staff believes markets are always too expensive or prices are too risky. And you guys went through a lot of work to develop a long-term policy that is based on much, much longer information than the short-term decisions that staff may advise you on. So maybe one partial solution is to have that.
Mr. Unterman?
Well, I have more or less the same question that Paul has, maybe thinking about it a little differently, and that is, I'd like to hear from our advisors whether they think the drag on implementation is a factor we ought to, and the friction in implementation is a factor we ought to consider when we come to basically what our target return is. Put another way, does the fact that we're taking a while to implement this as we judge markets, et cetera, and just because we're moving a massive amount of money, materially affect our ability to hit our target rate? And, you know, you don't have to answer that today, but I mean, that's I guess an increasingly important question.
Yeah, what's helpful in your case is that you're migrating from one asset allocation to another that have very, very similar long-term expected returns. So
Right.
you're not the transition shouldn't impact that, though there will be trading costs, implementation costs, et cetera.
Yeah, and it's not like we go to cash in between, so, yeah.
Tom, I would add, we looked at that when we developed this policy. So you remember, again, I'm trying to get it right for you guys, the efficient frontier.
Right.
We're on one dot. We're really close to it. We're zooming in and developing a step map of stepping stones to the other one. When you look back and look at a piece of paper, these dots almost look like they're on top of each other. So you're still trying to shoot for a 7.5, and with this policy, you're dealing with hundredths and thousandths of a decimal place out,
Right.
which, as Alan has said many times,
And we
asset
don't-
allocation isn't that exact in that area.
And we don't find ourselves with a lot of uninvested.
Yeah, and I would really emphasize, I'm fine putting a date, we've said our goal is to get there in about 3 to 4 years. The staff, maybe I was overly zealous in using inflation sensitive. That really is the one asset class we've had the challenge with. I mean, who would have thought rates would have gone to negative returns? It's still our intent to be a steady state investor. And I guess I would say the best way to describe it, Steve, and may help you, is we're not trying to time the market, but it determines our pace. We're marching toward that goal. Do we march really quickly because it's downhill and the wind's at our back, or do we march really slowly? And another example would be not just whether we like the market or not. We've had an account where everybody knows that we want to go more non-U.S. and less U.S. We've had instances where people have come to us and said, we have somebody that wants to buy a big U.S. Harry's example, if China wants to invest more in the USA, we can sell them a sleeve of our portfolio. That's an opportunistic thing we could do that's not based on a calendar. It's like, let's find out when things can come up. And so it's not just, we're not trying to call the markets and we're not trying to slow down your asset allocation. We get it. We're actually just trying to be smart about implementing it and not just rigid.
I think the point that answers my question is we're trying to move from 7.5 to 7.5, and that
I like how Tom reduces things down. Go ahead, Neil. You had some
I was
thoughts?
just going to say, for your information, you'll recall during the asset liability study, we saw a lot of numbers, a lot of estimates for expected return. They all penciled out around 7.5, and those took into account an evolving allocation from where you are now, evolving, similar to the table you're looking at now, evolving to the long-term structure that we were modeling. So that the evolution that you're concerned about was in fact in the numbers.
Thank you. All right, so we have this policy before us. We can take action or not take action. Open to a motion or the will of the investment committee?
I'd like to propose that we take action on it today
Okay.
with the amendment
With
that
the
Mr.
amendment.
Rosensteel expressed earlier in the discussion.
Okay, did you catch that, Lamont?
second.
Okay, so it's been moved and seconded that we accept the investment policy with the edit that Mr. Rosensteel suggested. It's been moved and seconded. All those in favor, any discussion? All those in favor say aye.
Aye.
Opposed? Abstentions? It's been approved.
Madam
Thank you.
Chair?
Yes.
I just would like to be explicit that unless there's opposition to this, I would like for us to be explicit in our direction to our staff and the leadership of the committee that we do look at a oversight mechanism for this over the next 3 years that is outside of this traditional format.
Yeah.
Thank you.
Yeah. Thank you, Mr. Kaler. All
I'm
right.
sorry, quick question I missed. Who
Sure, Brian.
seconded the motion?
Tom Enterman
Mr. Hunterman.
Thank you.
was great. Thank you. Item 10, Mr. Keeley, report on our subcommittee from March.
Thank you, Madam Chair. As the chair of the investment subcommittee, I wanted to provide a brief report to the full investment committee on the actions of the subcommittee.
Mr. Keeley, is your microphone on by any chance, or I don't hear you? There we go.
Thanks.
Go ahead.
As chair of the investment committee, I would like to provide a report to the full investment committee on the actions of the subcommittee. The subcommittee met in Sacramento on March the 3rd and heard presentations from the FTSE and Russell indexes on their low carbon index products, and also from MSCI on their low carbon and fossil free index products. The subcommittee instructed staff to develop a draft of special mandates policy to include a structure around the process when reviewing and selecting special mandates for the subcommittee to review and to consider at our upcoming meeting in May, which will be in Glendale. I am requesting that staff do some portfolio analysis on the impact of our global equity portfolio if we are to invest in a low carbon or fossil free index. And I've asked them to specifically to model the impact of volatility, tracking error, and the potential impact to the program shown at various investment amounts as part of this analysis. So I'd be happy to answer any questions. I believe all committee members were in attendance with the exception of Ms. Suman's not on the subcommittee. Frank was not at the subcommittee, so a majority of this committee was at the subcommittee. Thank you,
And
Madam.
can you reiterate the date for the next subcommittee, just so that I know members of the public are
It's
welcome?
May the 5th
May the 5th?
in Los Angeles.
At the
Glendale office.
Glendale Service Center.
Yes.
Any questions from Ms. Ortega?
So I'd ask for approval of the report.
I've got a question from Ms. Ortega.
Just to add that part of what we talked about at the end was also continuing to focus on coming out of this subcommittee with a process for evaluating these kinds of issues. So I think what would be helpful is, as the staff are doing the analysis, is actually keeping some sort of framework for how they're doing that, because that, to me, is what turns into a recommendation for making these kinds of doing these kinds of analyses in the future. So just keeping a focus on trying to come out of this with a policy or a process for evaluating these kinds of issues in the future.
That's helpful, Ms. Ortega. Thank you. Mr. Unterman?
Yeah, I agree. I mean, in my mind's eye, I'm thinking that one of the benefits of this exercise is we've identified kind of a core level of volatility and tracking error that's basic to our portfolio, and then sort of see how much tolerance we would have to try something else, either reaching for higher return or to follow a special purpose like this and try and evaluate these mandates within that framework is, which you can't be terribly precise about, but that would be the thought. And so, for example, if we're adding tracking error by looking at a sustainability index or a low carbon index, then the question is, should we be reducing tracking error and volatility someplace else? And if so, where? And I'm assuming that's sort of the nature of the staff's recommendation that will come.
Go ahead.
Just a final point on my thinking on this is that I remember at the conversation last time I was thinking at the end about something that I think we heard during our fiduciary training, was that sometimes the process is as important as the decision, and I think that's part of what I'm getting at is we need to really be able to document what a process would look like, not only for this discussion but for future discussions. And I think it helps the board in being able to respond when we get people coming before us as well.
And if I can respond, I agree, and I think what we're working towards is some sort of metrics and benchmarks that would guide a decision as we do it.
Great.
Just a follow-up, Ms. Ortega, just as an informational piece. Mr. Hunchman and myself had a follow-up call with staff, Ms. Sheehan and Ms. Kim, to make sure that we, in fact, were hearing the same thing and sending the same message to staff around crafting that appropriate process for the record and for future endeavors in this space. Thank you.
Okay. It's been moved and seconded. All those in favor say aye.
Aye.
Opposed? Abstentions? It's been approved. Excellent. Thanks. What I'd like to do is I'd like to take a couple more items. My thinking in our agenda, just so that we sort of maximize our brain power and energy levels, is to plan to break for lunch at 12. So I think I would like to have the investment beliefs conversation, item 11, after lunch, right after lunch. So I'd love to go ahead and do item 14, which is our private equity semi-annual report, John, if that's okay for you. And then we have some members of the public. Typically, we take public comment at the end of the day. I didn't want them to have to wait till the entire end of today. So I think what we'll do is we'll have our semi-annual performance report with Mr. Haggerty, and then, there's two of you, okay? And Mr. Haggerty and Mr. Hart. And then we'll hear statements from the public, break for lunch at 12-ish, and come take a half hour for lunch, come back and start with item 11, our investment beliefs conversation. Does that sound right to everyone? Mm-hmm. Okay, great. Mr. Hart, Mr. Haggerty, nice to see you.
Thank you. So our approach to this report, which is a 6-month report through September 30th, is to relate it back to some of the best practices that we discussed at the last meeting, and also related to some of the investment beliefs that you're likely to be talking about after lunch. We'll hit the highlights and keep it fairly brief for now. So beginning on this slide, you see that the portfolio is dominated by buyouts. That is common for programs of this size, roughly 2/3 of the portfolio. 68% is in the U.S., and almost half of the portfolio's commitments are represented by the 2005 and 2008 vintage years. That is notable as it relates to the pacing study that we had talked about at our prior meeting. Performance has been positive relative to benchmarks on a since inception basis, but as we have discussed, relative to the stock market in recent periods, it has underperformed. We presented to you last time on the public market equivalent, which showed a positive amount of alpha relative to the stock market. And I'll turn to our activity. Okay. There we go. Thank you. So for this period of time, we saw net positive cash flows of $2.5 billion, and the staff made a number of commitments totaling almost $4 billion for this period of time, and that compares to a significantly smaller amount for the 14 period.
Just quickly, a couple of comments about the marketplace. Page 8, as has been mentioned, that the pricing in the buyout market has been very strong, reaching kind of the all-time highs in terms of multiple cash flows. The equity component of those buyouts has also been quite strong in the 40-45% range, and with the balance in debt. Taking a look at this page here, this is showing in the marketplace as sourced by the Preqin, the data source there, that the positive cash flows have been received by limited partners over the last several years, really since 2011. the amount of distributions has exceeded the amount of contributions, and that has been continuing so far in 2015 as well. And this has had an effect on the LPs being able to reach their target allocations. A couple of issues and things to think about that we think about in the marketplace. Competition for the top tier funds is very strong. There's kind of a have and have not in terms of the GPs, that some funds are one and done raised, and there's a very little opportunity for new investors to get into those unless they're right on top of it. And general partners, as we all have been talking about, have had increased requests for transparency. The SEC has been doing review. The ILPA has come out with a revised template for fees and costs, and California has proposed in legislation calling for increased fee transparency.
So with respect to the program relative to its targets, each of the exposures for the major strategy types were very close or within their target range. The one exception to that was expansion capital, which was at 16.6% versus a target range of 5 to 15%. What's most notable, and we brought up at our last meeting with you, is the exposure at the plan level, which is 9.5% as of September, versus a target range of 10 to 15%. That relates back to some suggestions that we have with respect to pacing.
Go ahead. Can you chime in there, Tom? Thanks. Go ahead.
Could you just come back to that for 1 second? I wasn't sure I followed. So the percentage is a percent of exposure. The total program is 9.5%. I can't follow.
Yeah, there's two different bases there.
Yeah,
so the first rows that are in regular font as opposed to bold font are percent exposure of the in the private equity class.
Right,
And then
okay.
so the bottom row there is the total program, and the 9.5 represents total private equity as to the total CalSTRS program as of September 30th.
Okay.
So those numbers won't add, they're not supposed to add up. It's a different basis.
Okay. No, great. I just all of a sudden.
Sure, understood.
Very quickly on this page, we show the currency exposure, which is 86% US dollar. You have 68% of your exposure to the US strategies. The additional exposure comes from your rest of the world funds, which are quite often denominated in US dollars. Lastly, on this page, we indicate diversity across industry sectors. In our larger report, you'll see that the highest exposure that you have on a sector basis is to technology at 20%, and the second largest is healthcare at 15%. This compares to roughly what those sectors represent in the broad U.S. economy. So you're more or less matching the exposure that you see broadly in the stock market or in the global economy at large. As I mentioned earlier, a number of the commitments were concentrated in the 2004 to 2008 vintage years. That's something that we'll discuss when we revisit the pacing study. Here you have the largest exposures by manager, with the Blackstone Group representing roughly 9% of total exposure, and TPG Big Capital representing a little over 7%. This is not something that we find concerning. We consider it to be a reasonable set of exposures, given the fact that those two groups are among the largest private equity practitioners in the world. They have largely worked through succession issues, which is a question that we'll get to when we talk about the industry and some of the things that it's going through. And they're not typically dependent on any individual for their success. So these exposures, while fairly large, are with groups that we think are pretty robust.
So page 18 here, this is kind of mentioned back, this is CalSTRS cash flow exposures over the years back to 2004. You can see the net contributions into the portfolio through to about 2010, with 2008 being a very strong year for net contributions. But then since then, the distributions have greatly outweighed the amount of contributions. So they're still making new investments, but the rate of return back from the older investments in terms of your basis as well as profits have largely outweighed, greatly outweighed the contributions that have been made.
The proactive portfolio was not active in 2015, and no new commitments were made to managers. We show the performance, which has lagged the rest of the portfolio for reasons that we have not identified clearly through an attribution analysis, but they are all managed by fund-to-funds programs, which has issues of J-curve and additional fees. The remainder of the slides show the performance relative to two benchmarks. One is the State Street Private Equity Index, and the other is a custom benchmark, which includes public market indices. And the quick story is that since inception, the returns are positive. There's a solid margin of performance in excess of those benchmarks, but for recent periods, the performance has lagged. And when you look at the custom benchmark in the column of 3-year and 5-year, you see the reason for that. Again, a reminder, we're looking at a period that ended on September 30th. So these are very strong, above average returns for this period of time for the stock market. And this is not a reflection on the portfolio that you have, but more a reflection upon private equity as an asset class, relative performance to the stock market for this period of time.
Mr. Haggerty, I have a question from Tom.
One question, question, and it's going to lead to a suggestion for your future reports. One thing your report doesn't show is how the composition of our portfolio has changed by type, from big buyout to small buyout to venture to whatever, and distressed debt over time. And I think that's something that would be important for us to track. I know it reflects a very conscious strategy that Margot has, but I think we would want to see how that's being implemented. And second, I think as you get into performance reporting, it would be interesting to see how those specific subcategories track. Yeah.
We appreciate those comments, and I think you'll be pleased to see that level of detail when we provide you with the attribution analysis, which is the first project that we outlined for ourselves beyond the public market equivalent analysis. We have that level of detail provided on a vintage year by vintage year basis.
Okay.
So I think you'll be able to see that, and we're really trying with that exercise to isolate decision making and disaggregate choices about what strategies to be in from choices about what individual funds to be in. And we'll be able to see that perhaps at more granular level than is even helpful, but you can see it on a vintage year by vintage year basis.
Okay, I'd forgotten that was coming.
That's forthcoming. We have a draft of that.
But I think we want to see that develop. We want to be able to track that over time,
Yeah.
with some regularity.
Mr. Haggerty, when are we anticipating seeing that as an investment committee?
We have a draft as of today,
Okay.
and we just want to revisit some of the methodology, proof
Okay.
it, and be
maybe
able
June.
to provide that to you easily.
Okay.
Yep.
Great.
That should be June.
Thanks. And Controller Yi?
Thank you, Madam Chair. The private equity investments that are from the vintage years as they mature, do you have any feel for where there might be new opportunities that will arise?
I'm sorry if I could ask you to repeat the question.
Sure, sure. So as the private equity investments from the vintage years mature, where do you see new opportunities arising for us?
As has been discussed, I think at many meetings, we're in a very expensive market right now.
Yeah.
And I can speak on behalf of perhaps the house view of Makita Investment Group. And just to remind you of our role, we're not providing these inputs into the staff or through the consultant that staff works with, but we are using our flexibility to invest in distressed debt and distressed debt for control strategies, and to look at areas where the risk reward to us is more appealing, though they may have an expected return over a long period of time that is lower than private equity. So that's one area. If you move beyond private equity to an adjacent areas, we see the distress in the energy, mining, resources space as providing potentially interesting valuations, though risk and volatility, as Steve had outlined before when talking about oil prices.
I just want to highlight one other contextual issue. It's simple to say that private equity asset or transactions are expensive today relative to historical averages, but from a board perspective and a total fund perspective, what really matters is not the pricing of private equity in isolation, but the pricing of private equity in relation to other assets that you can choose to invest in. And as we've talked about, U.S. equities are very expensively priced as well. Fixed income is very expensively priced today. So the long-term objective of private equity is to outperform public equities. So the pricing relative to public equities is pretty reasonable. It's just that all risky assets are pretty pricey today.
Yeah, absolutely.
Wonder if you had a feel for, as the fee transparency requests are increasing, whether general partners are moving to embrace the ILPA template at all?
Well, we've done a survey of the general partners with whom our firm works, and we're getting generally positive feedback in the sense that most are feeling that they will be cooperative. They see it as bringing additional cost, and naturally there's a pushback on any kind of look into what they might consider a private matter, their compensation, which can be inferred by this data. But by and large, we are hearing positive things. We're hearing that most will be cooperative, and we're optimistic that the work that's being done right now by your organization through ILPA and ILPA itself is having a positive effect. There may be some difference in the market depending on where people get their capital from. So there will be certain managers that do not rely heavily upon organizations that have Freedom of Information Act requests, and they may be reticent to comply. So there is a mix. Generally speaking, the larger funds will be more cooperative and eager to comply, and I think that the smaller groups that have a different type of client base than the likes of CalSTRS will not.
Just a couple of
okay.
quick comments. So on that, one is that some of the GPs are looking forward to having a simple template to work with rather than having numerous requests from different individual LPs. So they can have something that's, in some cases, they're welcoming the ILPA template as something they can work with. They're a little concerned that it's going to be ILPA plus, and that every GP, every LP is going to have have this, but add these other things. So see as that develops as well, and that's my comment.
In terms of your question, Controller Yee, I think it's really important to recognize that there are already a large number of existing funds that don't do business with public pension plans. And in my opinion, those people who have the strongest performance and have the least desire to make things public will continue their existing business practice, and there's very little, if anything, you can do about that.
And one other comment is just that on our work plan for this next year, that work plan, Chris, that's full, is talking about fees and making sure we're looking at costs. And obviously, private equity and the carried interest conversation has been part of that. So we will continue to monitor what ILPA is doing and making sure that we have better understanding of the fees that we pay, especially in the private equity space. So, got a couple people in queue. Mr. Keeley.
Yeah, just for reporting purposes in the future, we gave us a slide which about the meaningful the more significant relationships, and this shows its inception, shows its numbers. I'd love to be able to see actually whether or not there is a group of managers and relationships that are driving this type of performance, and to know who they are. And just to maybe get an idea of staff's input and consultants' input as to whether or not those will be the same firms in the future to be driving these types of, who are the 320 hitters? If this was baseball, who's hitting 330 every year and who's hitting 270? Who's driving this? Is it equally distributed throughout the asset class, or there are really folks that have really been doing outstanding work in the future? Thanks.
All right. And then Mr. Moore.
I had another fee disclosure question, and it was about the SEC review. What's the time frame for that? When it's supposed to end? And are there any conclusions that have come out to date that you can share with us?
The SEC review?
Yes. Have you heard of anything?
My understanding is that it continues to go on. From talking to the different general partners we go through, different ones say they've had their presence exam, others say they haven't had it yet. So given the several thousand managers that are out there and the relatively limited SEC staff, it's just kind of going to be an ongoing process as they go through those situations. My
Will
understanding,
there be a final product that they'll come out with that'll have some conclusions, or will it be specific?
I think they're doing it episodically. As they find things, and they probably as they come to settlements on certain things, they make announcements. So I don't think there's ever going to be a time where, quote, it's done and then things are over. I think it's just part of the.
It's rarely in a regulator's interest to clarify things. So these things have a tendency to persist for a long time.
Thank you.
Yes, Alan.
Recently, we met with the SEC, and they have said they are going to increase the numbers of investigation and enforcements, and the only constraint will be resources. And they encourage the institutional community to let policymakers know that they should support increased resources for that purpose.
That seems to be the SEC's perpetual challenge is resources. So. Great. Continue.
So I will continue with benchmarking. This answers Tom's question somewhat. It compares the different components, the strategy components of the portfolio, to those components of the State Street Global Index. And so what you see again is very strong performance since inception, but also very close to this benchmark performance on interim periods. So the different segments of the portfolio are tracking the best peer index that we have at this moment to compare it to, and all are ahead of the benchmark since inception. And with on that page, and this the exception being distressed debt, this is a difficult category, as it's very difficult to know what's in the index for this. There's a wide range of risks that are taken with distressed debt strategies. Some are trading strategies. Some are designed to get control of businesses through a bankruptcy process. So without really digging in further to understand the structure of your distressed debt investments versus what's in the benchmark, it's hard for me to render an opinion on the since inception return. And I mentioned the proactive portfolio before. And lastly, here's a comparison of the fund investments to co-investments, and the story here is that since inception, the fund investments have outperformed but in recent periods, the co-investments have been outperforming the fund investments. I'll conclude there, and I'll try to relate our report back to best practices and to some degree the beliefs that you'll be talking about later. When we outlined our plan for you, the first thing we said that we would do is the public market equivalent analysis, which we've done. We're engaged now in the late stages of what I'll call attribution analysis, which answers those questions that Tom had asked earlier about where is your return coming from. Where has there been skill or luck exhibited with respect to selection of managers or sectors? The initial draft that we put together has positive results thus far, showing over a $2 billion gain relative to the State Street Index. So here's another data point showing alpha generation for the private equity program. The second item that we have is pacing, and the way that relates, in my view, to beliefs is whether you feel that some strategy or long-term policy of being somewhat mechanical makes sense, or allowing a certain amount of discretion to exist within the system of determining what your budget is and what your bite sizes are for individual funds. And also related to beliefs are costs, and the major item that we had put forth in the category of costs is building out or not building out your co-investment program. Beyond that, newer things to our agenda is the consideration of benchmark. This attribution exercise for us allowed us to really dig deep into the benchmark that your portfolio is compared to. We're coming to understand that there are structural differences between your portfolio and the State Street benchmark. And most notably, you have a lot less in venture capital than the benchmark does, something you'd always have to bear in mind if you continue to use that as a benchmark. And then lastly, a number of very specific board requests that you made at the last meeting. For example, an examination of the industry broadly, secession issues, and the whole host of things that you enumerated at the end of our last presentation.
Anything else from you? Yes, that's it. Any other questions from the committee? Great, excellent. Thanks so much, Mr. Haggerty and Mr. Hart. Thank you. All right, so we're going to move to comments from the public, and then go to lunch. So I have I have 5 requests to speak, and I understand we have a kind of a new process. So first is Jane Fosberg, Fossil Free California. Welcome.
Thank you, Madam Chair. Before giving voice to the CalSTRS members from across the state who are unable to attend, we at Fossil Free California would like to remind the board of the urgency of the climate change threat, as quoted by Christiana Figueres. At the Ceres Investors Summit in February, the Executive Secretary of the UNFCCC advised investors, your decisions over the next 5 years are really going to make the difference. If we put money into the wrong fuel systems, we are going to be dealing with those greenhouse gas emissions to the point that we will not be able to stay below 2 degrees Celsius. And I don't need to tell you what the social, economic, and moral impacts of that would be. We have to prevent global temperatures from exceeding 2 degrees Celsius increase. Otherwise, as NASA climate scientist James Hansen said, it'll be game over for the climate. And it is a myth that divesting from fossil fuels means a lower return. The MSCI report that was shown at the subcommittee last month showed how the fossil-free indexes have equaled or outperformed the S&P 500 over the last 10 years. And now the Mercer report demonstrates how, if the world leaders adhere to their commitment of keeping the global temperature increases below 2 degrees Celsius, CalSTRS, with its current investments, will lose $12 billion within the next 9 years and $123 billion by 2050. The report also advises CalSTRS to actively seek managers and strategies that focus on sustainability and to reallocate to low-carbon assets. CalSTRS board members, Thank you for following your divestment policy and voting unanimously to divest from thermal coal. We now call on you to fulfill your fiduciary duty and begin the divestment process from all fossil fuel companies. Not only is it morally the right thing to do, it is also financially the smart thing to do. And your decision over the next 5 years are really going to make the difference. And now I'd like to use the rest of my time to get an excerpt from Dan Greeny. He's a CalSTRS member from Reading. Dan Greeny says that the whole world spoke emphatically last November in setting a goal of stopping climate change at 1.5 to 2 degrees Celsius. CalSTRS dollars carry substantial clout to influence other decision makers. STRS can make the strong statement that will help other agencies, philanthropies, and businesses support and pursue a more sustainable, prosperous future and help enable the US and the world to make those efforts too. Last year, California's PERS and STRS oil and gas portfolio lost 28%, some $5 billion. This was just 1 year. But earlier studies had repeatedly shown that fossil-free portfolios perform comparably to fossilized ones. We must care about human beings. STRS should divest from fossil fuels.
Thanks, Ms.
Thank you.
Rosberg. Appreciate that. Robert Sylvie, Fossil Free California.
Thank you, Madam
Welcome.
Chair. Before I read a message from someone who couldn't be here today, I'd like just to mention that my wife, Deborah Sylvie, who will be speaking, is a retired community college teacher. And so we enjoy a most welcome CalSTRS pension. It matters to us that you continue to invest the fund's money with prudence for long-term solvency. And we feel that necessarily includes divestment from fossil fuels. So today I'm reading one of these many messages we've received from around the state. This one, excuse me, this is from theater and film director Kent Minogue, who's a retired Los Angeles teacher, a CalSTRS member, and a Fossil Free California founder. Kent writes, last year on June 6th, CalSTRS board members Harry Kiley and Dana Dillon joined a panel of teachers in Los Angeles to address the subject, should CalSTRS divest from fossil fuels. They heard Joe McLaughlin and me, two retired LA teachers, argue that divestment from fossil fuels is the best way to protect our retirement wealth from the shocks of risky investments in dirty energy. They assured us that they got it, but that it was important not to give up their power to engage polluting industries by selling their holdings in these companies. They did not address how they would use their positions to protect us from the steep declines that fossil fuel companies will inevitably experience as governments begin restricting emissions, utilities and consumers begin discovering cheaper alternatives, and citizens everywhere increase their opposition to the dangers of extraction. Kent finally concludes by saying, the difficulties with delaying divestment have become ever clearer since Trillium Asset Management released its report last August. It showed that our two giant pension funds lost some $5 billion by opting for engagement over divestment. As Trillium reported, this is a material loss of money which directly impacts the strength of the pension fund. Kent concludes, coal in its bankruptcy is the canary in the mine. All fossil fuels will be driven down by the same forces that hammered coal: government regulation of emissions, cheaper alternatives on the market, and widespread public hatred of their corporate practices. Engagement is dead. Please divest now before the market divests for us. Kent Minogue. Thank you.
And I believe your wife is up next, Deborah Sylvie. Welcome from Fossil Free California.
Thank you, Madam Chair. So I'll begin by reading from Lenora Dowling, professor at Rio Hondo Community College in Whittier. She's been doing that for a professor for more than 25 years. She says, it is imperative that for the sake of our planet, we work to prevent the irreparable harm caused by climate change. We can save our planet for future generations by divesting from fossil fuels. And from Sharon Markinson, she's a retired high school English language arts teacher from Woodland Hills. She says, I'm currently doing presentations on climate reality in high school classrooms, so it's painfully ironic to me to receive my CalSTRS check each month, knowing some of my money comes from investments in the corporations whose product is killing all of us, including the young people I warn about this disaster. One of the things I tell them to do is to make sure their colleges, when they get there, are divested. From Reza Rosenstein in Menifee, California, she says, please do not use CalSTRS funds to invest in fossil fuels or products. Invest in alternative energy sources, wind and solar, and investing in water would be prudent too. From John St. Clair in San Bernardino County, I was a public school teacher in the Ontario Montclair School District for 35 years. I strongly urge CalSTRS to divest from fossil fuels sooner rather than later because the long range prospects for fossil fuel corporations is not good. The realization that the human race must transition from fossil fuels to renewable energy is growing every year. And from Ellen Covisto, a public school teacher in San Francisco, a high school science teacher, she says, the message from science and scientists is really simple. Keep it in the ground. It's a horrific sham that our retirement is being used to fund the destruction of the world our students are inheriting. Please divest. And finally, from Randy Baker, who is in San Rafael, California. And he says that he believes that CalSTRS should divest itself of all investments related to development of fossil fuels. I teach at Terra Linda High School and believe the quick transition to more sustainable forms of individual transport or invest in more fossil fuel mass transit is imperative. Thank you very much.
Thank you, Ms. Sylvie. Bill Vosberg, Fossil Free California. Welcome.
Thank you again for allowing us to speak. I too am a retired high school and college teacher, and I do enjoy my pension. So thanks very much for taking care of that. I got my check on the 1st, and I appreciate the good job you have done of taking care of our pensions. But of course, we know that the climate change is presenting a huge threat to that pension for future retirees, for current teachers. I have, like my colleagues, some voices, some words from people who are concerned about the issue but couldn't make their way to Sacramento here today. This is from Rhonda Alexander, who lives and taught in Riverside. I'm a retired teacher, she says, and strongly support divesting from investments in fossil fuel companies. Certainly CalSTRS need to maximize returns on investments, and certainly CalSTRS needs to be a leader in supporting a healthy environment for our future generations. Why else do we teach? Both can be accomplished by divesting from fossil fuel companies. Please honor the lives of teachers and those they teach by taking positive action to divest immediately. This message comes from, Professor Christine Sepulveda, who is a faculty member at Saddleback College and El Camino College down by Mission Viejo, Southern California. Ladies and gentlemen, I've been teaching in California for 10 years and I'm a CalSTRS member. I'm writing to you to urge you to divest from fossil fuel industry. As educators, we must work very hard to enlighten others about the human impact on the environment and the global climate. We should be setting the very best example for our students and others, and it would be one of the most positive actions that CalSTRS can make by divesting from the fossil fuel industry. It would be better for people, animals, and the environment if CalSTRS would invest in renewable, socially responsible alternative energy sources. Thank you for your time. This note comes from Jeff Rime, who is a professor of English at Moreno Valley College. I am writing to voice my support for CalSTRS to divest my pension from fossil fuels. Fossil fuels are bad investments. Just as important to me is that fossil fuels are terrible for our environment. As faculty and teachers in public education, we should be doing all we can to protect our environment for the children and the youth we teach. Beth Adams teaches at L.A. Pierce College. I urge CalSTRS to divest from fossil fuels so our retirement can reflect the commitment to student success we make as teachers. There's no point educating teachers and thinking about their future if we continue to destroy the world our students will inhabit. Fossil fuels have no future. Please divest now. Thank you.
Masao Brown from Fossil Free, California.
Hello,
Welcome.
my name is Masao Brown, and I am a retired teacher. I taught in Berkeley and in Alameda, and I appreciate my pension from STRS. The first letter I'd like to read is from Diane Curiel from Hayward. Hello, I am a middle school science teacher teaching in Hayward. I strongly urge CalSTRS to divest from fossil fuels for the following reasons. 1. As a science teacher and environmentalist, I believe our future and our children's future depends on our ability to quickly transition from reliance on fossil fuels to energy sources which do not contribute to global warming. 2. As a teacher nearing retirement, I am concerned that there is a long-term financial risk in remaining invested in these fuels. 3. CalSTRS has already lost $2 billion from fossil fuel investments for the year 2014 to 2015. 4. CalSTRS has a humanitarian as well as fiduciary responsibility to divest and should begin this process now. Thank you, Diana Curiel. This one is from Anya Croth, who is from Cupertino, and she taught at West Valley College in Saratoga. My name is Anya Croth. I'm a retired teacher and a member of CalSTRS. I fully support the initiative to divest from fossil fuels. I even tried to send a message earlier to this effect to STRS independently of this present effort. Let's invest in solar and renewables with hope and respect. Anya Croth. This is from Jane Wallace, who teaches in Los Angeles. My name is Jane C. Wallace. I am a nursing instructor at California State University, Los Angeles. As a public health nurse and instructor, I want to be more aware of myself and make my students more aware about public health issues, including the harmful environmental effects produced by the burning of fossil fuels. I was surprised and dismayed to learn that part of my retirement pension is being invested in fossil fuels, which are one of the worst contributors to global warming and climate change. I was also informed that these investments are not increasing my pension funds. In fact, they are losing money. So this is not a sound financial investment for me. I request that CalSTRS please divest my pension funds in fossil fuel companies and rather invest them in greener and more economically sound companies. Thank you. This is from Terry Badger in Paso Robles. Sirs, I was a teacher, but the continued investment in what is killing our planet is unacceptable. There are plenty of good renewable energy companies in which you can invest, make a decent dividend, and help influence the direction of the company. This is the only planet we have. Thanks. Terry Badger. Thank you.
Thank you for the public comment. I appreciate it. And with that, we will take a break for lunch, and we plan to come back at 12:45 to start item 11. Thanks, everyone.